If you're a veteran and you've only used your VA loan once, you probably wasted it. And no one told you that. You were told 0 down, great rates, no PMI. That's surface level information. What they didn't tell you is that you were handed access to one of the safest, most scalable leverage tools in America. Civilians compete for 5 to 20% down payments. You were handed a government-backed bypass, and most veterans use it like a coupon. Today, we're breaking down the real military advantage nobody talks about. We're going deeper than eligibility, deeper than funding fees, deeper than it's a great first-time home buyer loan. By the end of this, you'll understand the hidden wealth mechanics inside the VA loan, how entitlement stacking really works, why assumability might make you money in the next rate cycle, how veterans quietly build multi-property portfolios without massive capital, and the mistakes that destroy veterans financially. This is strategy. Let's start with the biggest misunderstanding. Most veterans think, I want to buy a house. That mindset caps you. Strategic veterans think, I control leverage. Civilians don't. That changes how you make decisions. The VA loan isn't just about buying a primary residence. It's about controlling capital while using government-backed leverage. And to understand that, we need to actually understand entitlement, not the simplified version, the real version. Most people here, you can reuse your VA loan. That's incomplete. You don't use the VA loan like a coupon. You use entitlement. The VA guarantees a portion of your loan to the lender. That guarantee is based on entitlement. There's basic entitlement and bonus entitlement. Historically, loan limits mattered more. Today, full entitlement borrowers don't have a loan limit cap if they have full entitlement available. But once you use part of it, the math matters. Let's break this down clearly. Imagine you buy a $450,000 home using your VA loan. You put 0 down. The VA guarantees a portion of that loan. That portion counts against your entitlement. Now you live in the property for a few years. You get orders and you get PCS, or you decide to move. Here's where most veterans make a critical mistake. They think they have to sell the house to use their VA loan again. That's not true. You can keep the property, turn it into a rental, and depending on how much entitlement remains, you may be able to buy again using your VA loan. This is where entitlement stacking comes in. You don't lose the benefit. You allocate it. Let's say you purchased that $450,000 property and used part of your entitlement. Now you want to buy a $500,000 property in your new duty station. If you have sufficient remaining entitlement and your income supports it, you can purchase again with little to no down payment. Now you control 2 properties with 0% down on the first one and potentially 0% down on the second one. Civilians cannot do this easily. They're saving for years between purchases. They're putting down 5, 10, 20%. You're preserving capital, and capital preservation is where wealth acceleration begins. Let's talk about why. The biggest obstacle in real estate is not interest rates. It's not even market timing. It's capital. Down payments stop people. A conventional buyer purchasing a $500,000 home at 5% down has to bring $25,000 to the table. To avoid PMI, they need to bring $100,000 and put it down. Most people don't have that. Now compare that to a VA borrower. 0 down, no PMI. Let's do the math over 10 years. Conventional buyer puts down $25,000 and pays, let's say, $300 per month in PMI for several years. That's $3,600 per year. If PMI lasts 5 years, that's $18,000 gone. Now the VA borrower kept that $25,000. If that $25,000 was invested at an average 7% annual return over 10 years, that grows roughly to $49,000. And the $18,000 saved in PMI, that's roughly $67,000 in capital difference over a decade. That's not small. That's trajectory altering. Most people focus on monthly payments. Wealth builders focus on capital control. The VA loan shifts you toward capital control. Now let's layer something even more powerful. Scaling. Here's what most veterans never realize. If you follow occupancy rules correctly, meaning you genuinely intend to live in the property as your primary residence, you can build a repositioning cycle. Buy, live in it at least 12 months, improve it, move, convert to a rental, reuse entitlement, repeat. Over a 12-year career, you could realistically acquire 3 to 4 properties this way, depending on income and market conditions. Property 1 appreciates modestly. Property 2 appreciates. Property 3 appreciates. You now have stacked equity across multiple assets. And here's another advanced layer. When you convert your first property to a rental, lenders can often count 75% of documented rental income toward qualifying you for the next loan. That reduces your debt to income ratio impact. So the property that once limited you can now help you qualify. That's leverage compounding. Now let's talk about something almost nobody mentions: assumability. VA loans are assumable. That means if you lock in a 4% interest rate and rates rise to 7 or 8% in the future, a buyer may be able to assume your loan. Think about that. If the market rate is 7 and you're offering a 4, your mortgage becomes an asset. That creates demand. It can make your property more attractive. It may allow stronger negotiating power. Scarcity drives value. Low rate, assumable loans in high rate environments are scarce. Now flip the scenario. What if rates drop? The VA offers the IRRRL, the interest rate reduction refinance loan. Often, no appraisal required, streamlined process, lower friction. So in a rising rate environment, you potentially gain attractiveness through assumability. In falling rate environments, you gain through streamlined refinancing. That's asymmetric positioning. But leverage cuts both ways. Let's talk about risk. If you over leverage with no reserves, you create weaknesses. If you buy in a declining market without long-term holding power, you expose yourself. If you ignore vacancy risk, maintenance, or tenant screening, you can damage your financial stability. The funding fee also needs to be understood clearly. It can be financed into the loan, but it increases your loan balance. Disabled veterans may qualify for an exemption. Know your numbers. Understand your debt to income ratio. Maintain reserves. Always follow occupancy rules honestly. Fraud destroys careers. This strategy is powerful, but it requires discipline, and it's not for everyone. If you don't have an emergency fund, this isn't your first move. If you hate responsibility, being a landlord may not be for you. If your income is unstable, stacking mortgages without cushion is dangerous. But if you're disciplined, if you understand leverage, then you control something civilians don't. Let's zoom out. You were told 0 down. What you actually have is reusable entitlement, no PMI, capital preservation, assumable financing, refinance flexibility, government-backed guarantees, and scaling potential. That's not a basic home loan. That's strategic leverage. If you use it once, you bought a shelter. If you use it intentionally, you build momentum. And if you deploy it with long-term thinking, you create options. Most veterans don't lose financially because they lack opportunity. They lose because they lack strategy. You earn this benefit. The question is whether you'll use it at surface level or at strategic depth. If you want the full VA strategic scaling blueprint, including entitlement breakdowns, scaling models, qualification checklists, and mistake prevention frameworks, reach out or book a call below. Use what you earned. I'll see you in the next one.